I think we may be live.
I think so. And we're happy to have you back, Martha. Where the heck have you been?
Oh, well, hello and thank you. Thank you for having me back. I've actually been in Hawaii. I was in Hawaii, or actually, instead of Hawaii, it's Hawaii. Hawaii. I learned that's how you actually say it. And they know you're a tourist when you say Hawaii. And I don't like to look like a tourist. So I've been in Hawaii and I was in the mainland of Oahu. And then a couple of days after, we took a flight up north to the island of Kauai. And it was beautiful. One of the best trips I've ever taken in my entire life. For a long time, I thought Hawaii was a paradise that I wouldn't get to visit till I'm much, much, much older. So I'm very grateful that I got to visit it this time in my life.
Awesome. Awesome. Well, welcome back. We missed you, but I will say Jenna did a bang up job on filling in for you.
Yes, she told me all about it.
Why don't you get us started? Why the heck are we here today? Who are we and what's going on?
Yes, well, happy 1st of September, everyone. I can't believe we're already stepping into the month or the season of fall, which I love fall. I love fall. And it happens to also be we're going into our 31st week of doing this show, the Unscripted Real Estate Show. So welcome, everyone. Thank you for being here. My name is Martha Aguilar. I am the co-host of this show, along with this amazing team who I will be introducing in a second. And I'm just so happy to be here. I'm so happy to be back. So let's talk about who's in the room with us. So as I mentioned, Martha Aguilar, co-host. I help the team of the JS Realty through transaction management and all things marketing. We also have the show producer, Jenna Charpentier, who this would not happen without her. She started working at the age of 7 in Hollywood, California, appearing in several commercials, TV shows, and even a movie. And these days, she prefers to work behind the scenes by supporting the JS Realty team with day-to-day operations, marketing, and brand awareness. We also have expert realtor Beth Dunn. Beth is a Northern Virginia OG, having grown up in Loudoun County, so she's definitely watched the area grow and change quite a bit. Beth is also a powerhouse realtor, owning a few investment properties, and is the director of Samson Property Management. So her expertise comes from her years of professional and personal experience. Next, we have expert realtor Jeff Taylor, yet another Nova OG. Jeff is our triple threat expert realtor, licensed Class A contractor, and director of Samson Property Management. Jeff is very, very passionate and tireless about finding his clients quality properties for great values, even if it takes years and years to do so. We also have our expert Katie Hickey, co-founder of the Simmons Sisters team. Katie was born into a family of builders, developers, brokers, and loan officers right here in the Northern Virginia area. And it's no longer why she's becoming a driving force in the lending world. She has lifelong clients and is dedicated to helping people achieve the American dream of home ownership. And last but not least, we have Miss Sarah Taylor, the host of the show. She's an award-winning realtor, business owner, an entrepreneur, a real estate marketing consultant, a career development coach, philanthropist, podcaster, author, wife, and fur baby mom, and is the proud owner of the top producing JS Realty team. Sarah calls herself a matchmaker, and we could not agree more. Her proudest achievement is her successful matchup between the National Association of Realtors with the American Foundation for the Blind. Matching these two incredible entities will create awareness, access, and opportunities within the real estate industry for blind and visually impaired individuals. So that is our entire team, and I'm so happy to be back here. And today we will be talking about the top 10 things to consider before buying a home. And I'm really, really interested to hear about this, Sarah, because I've never Googled it. And I'm sure a lot of people Google it before they purchase a home, but maybe some haven't heard some of the things you'll mention today.
I do not know if anybody actually Googles it before they buy a home.
Maybe I
We're
just
getting
Google
started
everything.
on the process because I think, Katie, correct me if I'm wrong, but most people pick up on the internet and start looking at houses online, which is the fun and exciting and easy part. It's super dreamy, and it is where the magic starts. But I don't know for sure if that's really where it should start, because I think what happens oftentimes is you might fall in love with something that reality is you may not qualify for, and or you may not be able to purchase. Or what I see more often than not is people's purchasing power is way more than they think it is, meaning what they've been putting themselves in online, maybe they can actually afford more. So we do want to talk about the top 10 things to think about and consider when buying real estate. And I think the first thing to consider is debt to income ratio. Why the heck does that matter? I can pay my bills. I have extra money in the savings account. Why do you care how much debt I have? That is the question for Katie today. Starting with the top thing that I think that we start with when we're looking at someone and where they qualify.
So we want to make sure that your debt to income ratios are in line, that you can afford to pay the mortgage. We don't take into account, obviously, vacations, kids, daycares, eating out. So a lot of that has to be done by you on the side, knowing what you're comfortable with affording, because sometimes I can go to a client and say, at a 40% example, debt to income ratio, you can make this payment and you qualify. Where another client may have multiple kids, they may have daycare, they may have expenses that we don't take into account. So it's important for us to go through that and make sure that we can qualify you based on the debt to income. But even more so than that is for you to make sure that you're comfortable with that payment, because we don't know a lot of those hidden expenses and how your lifestyle is.
Well, I love that. It's like a little built-in protection for people so that the consumer doesn't get in over their head, right?
Mm-hmm.
And actually go out and maybe they do qualify for something, but it's going to push them into a range that would be unhealthy for them to potentially make payments in the future.
Mm-hmm.
So a debt to income ratio is major items such as car payment, credit card, anything else, gas cards.
Any homes that you might own, but basically any of your credit cards, credit card debt, car debt, and then student loans.
Student loans, okay. And then taking all of that into consideration, it's a percentage of the debt in those areas versus what you actually make. Is it what you actually make gross, or is it actually what you make net?
It's your gross income.
Okay. All right. Thank you. That's very
And
helpful.
the range can be anywhere from 38 to 60%. It depends on the program. But like I said, the ones that go on the higher have other income, that whether it's family members or somebody else helping with the mortgage. So it's always important to sit down and make sure that you've done your budgeting for your true debt to income ratios.
Yeah. When we ask people to reach out to lenders sooner than later, Beth, Jeff, and I don't run DTIs. We don't run debt to income ratios. We don't even know for sure exactly what categorizes under everything. That's why there's a professional that does, because there's lots of boxes that Katie and her team are checking, and they are making sure that you're fitting into the programs that allow different types of things based on what your situation is. And what we find is everybody's situation is different. So it is important. And as much as your realtor could say, hey, you can get in for about this much a month, and that might all sound comfortable, we really need to rely on Katie and her team to get you qualified and understand what's going to be best and healthiest for your family, so that when we do start the buying journey, we're headed in the right direction. One of the next things, and this is a qualifying question we ask all the time, Jeff, I'm going to get your input here. This is about duration of stay. Like, why does it matter how long a client's going to stay at a house?
Good question. Off the top of my head, it could be the way that the loan is structured. If they're going to do some sort of ARM or something of that sort, it could have something to do with if they have children. what schools they want to be in. Maybe the middle school's great, the elementary school's great, but the high school's not so great. So yeah, looking at 4 or 5 years before they have a little freshman, and they might want to move across town to the really good high school. Could be one of those types of things. It could be maintenance issues if they're moving to a house that has like an 8-year-old HVAC, and they might want to figure that, okay, within the next 10 years we're going to have to replace it. Maybe some of the other systems in the house. It could be a maintenance type of situation, looking into the future. How long are they going to be there? What are their expenses going to be? And I'm sure there's a bunch of other things. That's what I came up with
On the fly.
right
Thank you.
Right.
That's awesome. Anybody else have anything else to add? Like, why does it matter how long they stay?
Also could just be the simple fact of closing costs involved, and there's closing costs involved with buying, and there's closing costs involved with listing and selling. And if it's somewhere where you're only going to be a year, do you now have, after a year, considering all the various closing costs, do you have enough equity? Does it make sense financially?
I love that answer. And so we do actually care and want to know how long you're going to stay at the property. And even your lender wants you to stay at the property for a period of time. And they don't have any sort of air quotes minimum unless it's built into your loan, but they would certainly prefer if you keep the house for at least 6 months. And to your point, Beth, there are closing costs and there are taxes and fees that are paid along with purchasing a home and or selling a home. And so at what point does it make sense to not invest? Or to your point, Jeff, at what point does it make if we're going to stay in a house for 15 or 20 years, does it make sense to invest sooner than later in some major systems, some major upgrades, etc.? And
or buy a house that has newer systems.
Yeah, exactly. So thank you guys. Great answers to that. Job security is a big one. Recently met someone who changes jobs a lot, and that kind of became a problem for them. So Katie, would love to hear about how job security is viewed and or some kind of minimum benchmarks on changing jobs and changing jobs within your industry. What's the difference on those?
Of course, real quick on the time that you're going to be in there, that just to backtrack a bit, but that's super important because of ARM programs right now. Obviously, with the rising interest rates, a lot of people are going into ARMs. A lot of people, I'd say a large percentage of people don't stay in a home for 30 years without refinancing or selling. So it's always important to check those out because the rates are about 1.5% different. But as far as job security, if there's big gaps, we do have COVID to kind of lean back on. That can be an explanation. If there's big decrease in income, a lot of times we can explain that. If anyone's good at it, I can tell you Draper & Kramer is amazing at getting through those. But if you're job hopping, gaps in employment, not sticking with the same line of work, you're going to have a lot of red flags for an underwriter. Going from self-employed to contracting, back to W-2, a new job with a 6-figure offer that you've always been getting 5 figures in the low 5 figures. We've been seeing those a lot, and when we go to question them, it's a temporary thing. And as soon as they settle on a home, they are no longer with the company. So we have to be really careful with those. And a lot of people say you're asking for everything but our blood work. And a lot of times we are in that situation because we need to make sure that we're protected and that you're also going to be able to make the payments.
Well, I love that because again, what I'm hearing is sometimes it can be difficult to, come up with explanations and jump through the hoops that it takes to prove yourself within it. But I think that's what we have to remember is that we're borrowing someone's money and they're looking out for our interests as a consumer to make sure that we can continue to afford the property and not get ourselves in a really stressful situation of not being able to make payments. Mm-hmm. Another great thing to consider and think about when you're looking to purchase a home. The next thing that I think is going to be a really interesting topic is down payment. And Martha, you had a great question about this earlier before we even got the show started. And I'd love to lean in. I know that in your head, you have had a minimum down payment that you felt like is needed when you go to purchase a home. What was that about? And what was it? What was in your mind about that?
So it was about the credit that we were talking about, where I know what my credit score is, and I see a certain number that I know it is about. And I know we're not talking about credit, but it was on credit. And I'm not sure if you're trying to tie both together on down payment and credit. But
Let's come back to the credit one. As far as the down payment one, I'll just kick it over to you then, Katie. I think
I have a
what we
question about
need today. Oh, Jenna, there she
Sorry.
is.
I always thought you needed 20% down, and we do not have 20% saved of anything. And especially after COVID and everything, when everything just kind of stopped for a while, like any savings we had was gone. So that's been our biggest struggle, is like, we don't have an extra 50, 60, 70, $80,000 sitting around to throw at something. So what do we do?
So most first-time home buyers come in with 5%. That's just kind of the go-to. A lot of people, kind of to answer your question, Sarah, think in their head that they need 3.5%, some think 5%, some think 20%, because that's what their parents needed, and everyone's so scared of mortgage insurance. And mortgage insurance is such a tiny amount of the loan, like minuscule, under $50 in most cases, definitely under 100. So if you're like, oh, if I don't have the full 20%, I'm gonna have to pay this. As soon as you get to that 20%, you can get rid of the mortgage insurance. So it's not with you for the life of the loan like it is on FHA. FHA, a lot of people love the FHA program, thinking, once again, that's what their parents have told them, like, if you have less than 20%, you have to go FHA. FHA is good for people with high debt to income ratios, people that have parents living with them to help them pay, people that have bad credit scores. But we require for first-time home buyers a minimum, well, we have 3%. And then we also have 5% for anybody else that's buying a single family home. We just have now rolled out 100% financing programs where you don't need anything. And
What? Say that again.
days. So 0% down payment. So you just
Wow.
come to the table with the closing costs.
That is amazing. And what kind of benchmarks do we need to reach for the 0% down?
So for the 0% down, it's going to be a lower debt to income ratio. It's going to be credit over 620, first time home buyers. And then obviously the rate's a little bit higher, but not much more than market, about 0.5% higher than current market rate.
I love that. So first time home buyer is a qualifier for that. I hear you on that.
Exactly.
Okay. But we haven't had that program in a really long time. So I'm excited to hear that. Does that program come with an ARM as well?
That program does not come with an ARM. It's just
Okay.
But
Are there
the
income requirements?
in ARMs right now, you need at least 20% down. Otherwise, it just doesn't make sense because the 30-year fixes are still low enough.
Gotcha. Okay. What's your question, Jenna?
Are there income requirements on that? Because I know in the past, like when we've looked at some down payment assistance program, it was like, oh, well, you don't make enough money to buy the house, but you make too much money to get extra help.
Great question. So you make too much money. The good old, you make too much money for down payment assistance. That's typically going to happen in this area. There are income requirements. There's also a website. There's a Home Ready and a Home Possible website with income limits, and you can type in the address and it gives you the income limits. Typically right in this area, right around 119 is a good number to think of. But if you start getting into down payment assistance, no. Now, do I recommend going that route? I mean, I would recommend going the 3 to 5% route, way over 100%. But if that's your last option, then don't go into a rental versus going for 100%.
Right, right. I love that. And I want to talk more about that and actually reaching out more to folks who are in need of that product and really kind of seeing what we can do as far as getting them into home ownership now that we have this fabulous program. So thank you for mentioning that, Katie.
Of course.
And local market indicators, Jeff and Beth, I'm going to kick this to you guys. Why does it matter about what's happening in the local market versus what's happening in the national market that you want to purchase in?
I think it's kind of all that matters. You know, I think one of the old adages in real estate was, you know, real estate is local. you know, there's location, location, location. Everybody likes to say that, but you know, all real estate is also local. Like it doesn't really matter. I mean, I'm sitting here in McLean now. You know, it doesn't even matter what's going on in, say, Charlottesville. You know, for us right here, I think a lot of times I think it actually gets down to being that specific sometimes with real estate. So, you know, at least I don't know what you're driving at as far as national and local, but I know, you know, the news sometimes gets people into a frenzy because what's going on in Idaho is definitely not what's going on here. You know, just using that as an example. So if, you know, sometimes when you watch the late night national news and they're, you know, it's all gloom and doom or, you know, what have you, even with the job market, especially here, you know, it's just apples and oranges.
Great explanation. And Beth, I am certain you have something to add on there.
Yeah, I mean, that pretty much sums it up. I mean, you know, national, I mean, I it's even local versus local. I mean, you know, on my side of the mountain, our market's always a little different. Not always, but a lot of the times, especially during these past few years, versus your all side of the mountain. And by that, I mean like Loudoun County, Fairfax versus Warren County, Frederick County, you know, all of those different areas. We saw a little bit of a lag time in the feeding frenzy of the market during COVID. And then that then finally carried over to our side of the mountain. And I think we're in it's still of a hot market here. But I think it's starting to kind of slow down along with, you know, where you all are at as well. So, I mean, we're talking about like 40 miles difference. So national, and then there's local, but then you got your different sub markets in your local market. So it's just too different to be able to say or compare anything like that.
I agree. And it makes me think of something that probably happened 7 or 8 years ago. You guys correct me if you remember the timing on this, but ExxonMobil took their headquarters and moved to Houston. And that was a time period where the market was doing well and it was nice and steady. But then we knew at pretty much one kind of period of time, we were going to have about 20, I think it ended up being about 2,000 people that moved to the Houston area from our market. So that had an impact on how housing responded that year. And so there can be little shifts in our market, and working with people who know what's happening on in business side of things. For example, I don't know if you knew, but Raytheon is moving their headquarters here. So another great push for Northern Virginia, in that jobs are coming in, which could lean to us still continuing to have a pretty tight housing market, which means low supply, and also leans into needing your experts to help you through the process, which can get a little intense when the supply of housing is low. Does that make sense?
I mean, we saw that market. Jeff, was it last year? What was it? Was it Navy Federal? Or what are the banks that moved out to Winchester? And then we had an influx of people that were, for our rentals, they were all working. I think it was Navy Federal. Don't quote me though. But it was one of the banks that shut down a place in Vienna and opened it up in Winchester. And we just had an influx of people working for them, and Amazon. That was another one that they had I don't know, warehouse, something out in the West Virginia border. And it just created a bit of a rental and purchase frenzy out here.
Yeah, job market's huge, and that does affect supply and demand. And that would be our 10th item to consider when purchasing a home, is the supply and demand in your area. And so what is going to be available for you in the area that you want to look for? And are you going to be in a lot of competition? Or is it going to be a little bit more of a normal market? I feel like today we're in a little bit more of a normal market. Those who were getting beat out earlier in the year are now winning. They're actually getting home inspections, and there's a little bit more of a level playing field. So still a really great time in Northern Virginia to buy, we don't have a ton of supply, but the demand has slowed down slightly. And so that's what's opening up some options for a lot of our buyers who had no options January, February, and March of this year. So checking in with your realtor about what's happening supply and demand wise is also going to be really important. I was talking to some folks who are moving out of the area. They're not first-time home buyers. They're seasoned home buyers, but some things for them to consider in the different markets they're looking to purchase in, and they're not Northern Virginia markets, is what businesses are coming to the area, what kind of new development might be happening in that area, and what does the future of their real estate market look like? And also, what kind of support is there for them if they choose to do a renovation project, and or are there actually workers that can help with them with that type of a project? Because there's some areas right now we know that supply of workers is just in general kind of tight. So you don't necessarily want to dive in and pick up that great reno project if you can't find people to help out, and that's what you're needing actually. So that is a recap on the top 10 things that you should consider before buying a home. So the best thing, and what was at the very top of the list, is reaching out to your favorite lender or realtor and making sure they put you in contact with your favorite lender. And Katie and her team, the Simmons sisters team, are really doing an amazing job. I can't say enough great things about them this week. We had one easy peasy settlement that we were able to move up with them a week in advance because they were so on top of it, got the job done, and everybody got involved. Everybody involved wanted to move the settlement up, and because their team was so ahead of the game, we were able to do that. And by the way, folks, that was a VA loan that I'm mentioning, which are next to impossible to get done in 3.5 weeks, but I'm pretty sure that's all it took for you ladies over there. And we had a less than easy transaction, and her team was the funding team on that side, and they were so flexible. They allowed us to move the settlement date, and they were just so easy to work with. So we really appreciate you guys and all your patience and professionalism that you put in and making us look good. Damn it. You guys made us look good on
all
both
these
accounts.
closings. You guys are rocking and rolling. Getting good deals for your clients, and appraisals are still coming in over, which isn't happening very often these days. But they are for you guys.
Yeah, I love it. I love it. That means we're finding some great homes for our folks and also putting them in the right direction so that they're not overspending right now. So thank you guys. Martha, do you have any, I know sometimes you come up with a brilliant question. You had said something about credit earlier.
Yes, so my question was about credit cards, credit scores, and how, someone like myself could go on creditkarma.com or could probably go on their bank's app and check like the credit report and see that you have an 808 credit score. And then I remember Katie mentioning that mortgage reports and credit and checking the credit could probably be like 100 points down, so probably end up being like 710 when you're looking at an 808 credit score your entire last like 4 months. So I wasn't shocked by that, and I wanted to like know more about what is the difference. How can is there any way to seek for that score on my own, or is that only through a loan officer? Like more on that.
So we can 100% help you with that. We would be the ones to pull it. We will not make you buy a house. We will happily provide you with a copy of your credit report. Most people won't do that because it does cost money to do. But I always want people to know this is where your home loan score is. These are the 3 scores we pull. They're much more difficult pulling. Perfect example, I bought a house and a car last year, and I had a 72-point spread there. And then somewhere in the middle delta of those 2 numbers was Credit Karma. So most of the clients that come to us are looking at Credit Karma. Credit Karma is not your 3 scores. It's not your 3 mortgage scores. It's Credit Karma, credit score, and it's typically Experian. When you go to buy a home, we are pulling TransUnion, Equifax, and Experian. So those 3 scores. And same with the car. Most car companies will pull at least 2 of those, sometimes 3 of those. and a car scoring is much more lenient than a mortgage scoring. So, you know, if you look, you'll see that that's a pretty big difference. When we do pull it, then we can make suggestions. A perfect example is 700, 718, 719. Those are excellent credit scores, right? But if you're putting down less than 20% and your scores are less than 720 or even 740, it damages your mortgage insurance a lot, like a big difference. So I had somebody the other day that was at 719 and we had them go out and spend $14 on their credit card and send us the credit card bill. And we were told that was going to push their scores over 720. So when we make the suggestions, we make them so that you spend exactly that amount. Like if you have to pay cash for the rest, you do, because we ended up sending, he spent $6 over and we had to rescore again once we got that exact number, because it was just a secret number. It's kind of the tricks of credit scoring and credit rescoring and how they work. So we make those suggestions and can pump those out pretty quickly after running a score, probably, you know, within 20 minutes.
Again, another reason why Beth, Jeff, and I are not able to tell you what you can get for your loan and your lending options. That's because Katie and her team are the experts, and they're going to really be able to just drill down and figure out what's going to be healthiest for you, for your family, and making sure that you guys are going through the process with the least expense and the safest way. So great question, Martha, and really beautiful distinction, Katie. Thank you so much.
Yeah.
And I hope our audience has learned a lot today. We've gone on over some really, really great information. And I want to thank you all for joining us at the Unscripted Real Estate Show. This is unscripted. This is just all of us being real with you and us bringing professionals together to help you understand the real estate market better. We look forward to seeing you next week. Thanks for joining us.
Thank you.
You.